Lesson 10. How chart patterns lead to big profits. There were several different patterns to look for when doing technical analysis. And this lesson, Bill O'Neill discusses a couple different patterns and also goes over some mistakes to avoid when chart reading.
When did you realize the importance of reading charts?
I first discovered how critical charts were in 1959, 1 year after I became a stockbroker. At that time, there was one mutual fund that happened to be materially outperforming all others. I got a weekly chart book and posted from prospectuses and quarterly reports the price at which the fund purchased every new stock during the prior 2 years. I discovered something very important. What I learned was so startling, it simply changed my whole view about how to pick winning stocks. Every single one of the approximately 100 new stocks the fund purchased was bought only after it bolted into new high ground in price. For example, if a stock had fluctuated back and forth between $40 and $50 for 3 to 6 months, this number one fund only bought when the stock made a new high at $51. Let's stop and think about this concept for a moment. The idea of buying a stock at the highest price it has ever sold for just as it's coming out of a correct basing area seems ludicrous. After all, most of us were raised with the idea of getting a deal, a bargain. I'm here to shatter a common and comfortable misconception. What applies to buying merchandise on sale at a department store works in the completely opposite way when dealing with stocks. Do you want stocks that have the greatest potential for moving even higher? Then you've got to ignore the erroneous old saying, buy low and sell high, and replace it with buy high and sell a lot higher. It's all a matter of perspective and experience. Look back at a huge winner like Cisco Systems. From its original new high pivot point of $30 in October 1990 through October 1998, it has increased an incredible 15,650%. The original new high pivot point was actually low. It seemed high only because its price history was all that was known at that time. The incredible gains to come were not yet visible. So high is rarely high when you're looking for really great companies.
What are some other price patterns that emerge before stocks take off?
In addition to the common cup with handle pattern, see the graph of the next page for an example of a double bottom chart pattern. American Power Conversion's 39-week pattern in 1990 looked like a large letter W. The midpoint of the W at point C should be below the high at point A, the beginning of the pattern. A to B is the first bottom, points B to C is the increase to the midpoint, and points C to D represents the second leg down, the second bottom in the W. Normally, the second leg down will drop slightly below the absolute low of the first bottom at point B. This serves as a shakeout and helps wear out or scare out the last few weak shareholders. D to E is the last leg up in the W, and points E, F, and G form a short handle. The correct buy point is slightly above $22 at point G as the stock breaks through the peak price of the handle, point E. Note the high increase in weekly trading volume shown at the bottom of the chart when the stock moves up through the breakout at $22. The stock at the buy point had an Investor's Business Daily earnings per share rating of 99, a relative price strength rating of 95, a return on equity of 53.8%, and a 25% annual pre-tax profit margin. It advanced 800% in the following 22 months from point G, which at the time must have looked very high and scary to most investors. Notice also the huge weekly volume on the one-week price run-up from $18 to $22 at point C. One last observation. During the last 3 weeks of December and the first week of January, the stock closed in a very tight range around $17, and the volume dried up to the lowest level in the entire base. Most people will never spot this, but it is usually a constructive sign as the volume dry up indicates there is no more selling coming into the market.
Any other price patterns to look for?
Another somewhat common pattern is the flat base. It can occur after a stock has formed a cup with handle and has then continued to move up. Simply, the price pattern moves straight sideways and holds tight for at least 5 weeks, normally only correcting 8 to 12%. At the end of this type of pattern, a new pivot point is established, giving you a new chance to buy or add to your possible earlier cup with handle buy. You want to buy a stock exactly at its pivot point as it breaks out of a sound pattern. Don't chase it up more than 5% past its pivot. If you do, you will be buying more extended in price. It always pays to start exactly right and not be late. Your risk of being shaken out on a normal price correction will substantially increase.
What are some mistakes you can make in reading charts? And is there such a thing as faulty base patterns?
1. Short bases of 1 to 4 weeks in duration are very risky and usually fail. Avoid them. 2. Patterns that are abnormally wide or loose in overall appearance are more risky. It's safer to buy tighter, better contained patterns with less wild price fluctuations. 3. Stocks that shoot up straight from the bottom of a pattern into new highs without any pullbacks or handles are risky and frequently have sharp sell-offs. 4. A base breakout with no real increase in volume should be avoided. 5. Laggard bases. The last stock in a group to break out to a new high is weak and a laggard. It should be passed up. 6. Handle areas that are too wide and loose, down 20 to 30%, or handles that wedge up along their lows rather than drift down along their lows are faulty and frequently fail. 7. After a stock has had a long advance, the fourth time the stock forms a base, a fourth stage base, is usually too obvious to everyone and will probably fail. More on this in Lesson 11. Once you learn to read charts and correctly recognize stocks with sound base patterns that are under accumulation and possess all of the fundamental earnings criteria we mentioned earlier in this book, your performance should significantly improve.
Summary. Some of the price patterns to look for when choosing stocks are the cup with handle, double bottom, and flat base. There are faulty base patterns, so watch out for the following. 1. Abnormally wide or loose handles. 2. Upward wedging handles. 3. Wide or loose overall base patterns. 4. Laggard stocks that are the last to form bases among stocks in their industry groups. 5. No increased volume during breakouts. 6. Fourth stage bases. 7. Short bases. Replace the old adage, buy low and sell high, with buy high and sell a lot higher. You want to buy a stock at its exact pivot point. Don't chase it up more than 5% past the pivot.